Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week, two supposed AI stocks with government contracts got hit hard, and I'll show you why. Our first stock is RELX. RELX is a global information and analytics company that sells high-value data, research tools, and AI-powered software to businesses, governments, and legal professionals. The company operates across four main segments. Its risk division provides fraud detection, identity verification, and compliance analytics. Its legal division combines traditional legal research with a growing suite of AI-driven legal technology. Its STM division focuses on science and medical publishing. And its exhibitions business runs trade shows and conferences around the world. For years, RELX has been viewed as a high-quality, steady compounder with mid-single-digit growth. But what pushed the stock to recent highs was investor enthusiasm around the company's expanding AI products and its large proprietary datasets. So why is RELX hitting new lows? Simply put, the market is reassessing how much AI can realistically accelerate growth for a company like this. RELX is still a mid-single-digit grower, yet the stock was priced like AI was going to meaningfully turbocharge its revenue. When investors pulled back from the every company with AI goes up mindset, RELX was one of the names that got hit hard. The government shutdown scare didn't help either. RELX has exposure to public sector clients through its risk, STM, and legal divisions, and even the possibility of delayed contract payments pressured the stock when sentiment was already fragile. Another factor is concerns about AI commoditization. Analysts questioned whether RELX's new AI tools overlap too much, and whether large language model providers might eventually erode its advantage by training their own systems on broader datasets. RELX pushed back on this, emphasizing its proprietary data and customer stickiness, but the doubts still weighed on investor sentiment. Put together, the story isn't that RELX's business is deteriorating. It's that expectations got ahead of themselves, and the market is now resetting those expectations to something more realistic. RELX is a high-quality, steady compounder. Revenue is growing at a mid-single-digit pace, with the risk segment performing the strongest, driven by fraud detection and compliance tools. Legal is also showing promise, especially as new AI-driven products are rolled out. STM revenue is slower, growing around 5%, reflecting both its mature market and the fact that AI deployment in this segment is still ramping. One of RELX's biggest strengths is its sticky subscription-based revenue. Most customers sign multi-year contracts, which provides predictable cash flow even when market sentiment swings. Margins are healthy across the board, and the company generates strong free cash flow, giving it the flexibility to invest in AI products and expand into adjacent markets. Analysts have flagged potential product overlap concerns and the risk of AI becoming commoditized, but RELX's proprietary datasets and integrated tools give it a competitive edge that helps maintain customer loyalty. In short, the fundamentals are solid. It's the expectation reset that has driven the stock lower, not deteriorating results. At current levels, RELX trades in the mid-24 PE range, which is expensive for a company growing revenue in the mid-single digits. The stock is still coming down from its AI-driven highs, and I think it eventually settles closer to its long-term average multiple of about 19. The company's long-term growth rate is around 10%, but with higher interest rates in the UK and rising interest rate expenses, using 8% is more conservative. If we combine that with a forward earnings yield of roughly 4%, we get an expected return of about 12% a year. That implies a roughly 32% total return over 5 years, primarily driven by the forward price-to-earnings ratio coming back down to earth. Personally, I think RELX is still a great business, but not a great stock at this valuation. The company has sticky customers, strong margins, and decades of consistent execution. But none of that changes the fact that growth is slow and the market was pricing it like an AI rocket ship. After the recent pullback, the stock is more reasonable, but not compellingly cheap. If you're looking for upside, you may want to wait for a better entry point. The biggest risk for RELX is that AI becomes increasingly commoditized. If large language model providers eventually match or replicate tools built on RELX's proprietary data, the company's pricing power could erode over time. Analysts already worry that some of RELX's new AI products overlap, and if customers start to see them as interchangeable, the company could face slower adoption or more pushback on stacking multiple tools. Another risk is its exposure to government contracts. Even though RELX's business is stable, moments like the recent government shutdown scare show how quickly investor sentiment can turn when public sector spending is questioned. But the broader lesson from RELX is simple. Not every company with AI products becomes an AI growth story. Some companies will simply use AI to release better, stickier products, and that's it. Investors need to remember that anytime a slow and steady compounder gets swept into an AI narrative. RELX remains a steady, mid-single-digit grower. The market just briefly priced it like something far more explosive. RELX shows a company hitting new lows due to AI hype calming down and investors becoming wary of companies exposed to potential government shutdowns. Motorola Solutions continues this trend. Motorola Solutions isn't the old Motorola phone company you used to know. It's now a mission-critical communications and public safety technology business. The company sells radio systems, command and control software, video surveillance, body-worn cameras, and now increasingly AI-powered tools used by police, fire departments, and defense agencies around the world. The business is split into two major segments: products, which includes radios and devices, and software and services, which is the real engine of margin expansion. Software grew 10% last quarter, outpacing the 6% growth in products, thanks to rising demand for cloud-based command centers, video management platforms, and real-time analytics. The company is also in the process of completing its Silvus acquisition, which strengthens its presence in military communications and unmanned systems. Silvus brings resilient radio networks used in drones, defense robotics, and advanced battlefield communications, essentially pulling Motorola deeper into defense tech. With a massive backlog, strong government visibility, and expanding AI features across its devices and software, Motorola Solutions has quietly become a surveillance and defense technology company with recurring revenue at its core. So why is Motorola Solutions hitting new lows? A big part of it is the same trend we saw with RELX. Investors have started becoming more discerning about anything labeled AI, especially when those companies rely heavily on government contracts. Motorola said the shutdown didn't affect its operations, but delayed payments and budget uncertainty were still enough to shake confidence when sentiment was already soft. Another issue is that the company's growth story is harder for the market to categorize now. Motorola isn't a pure software company, it's not a traditional defense contractor, and it's not a flashy AI play. But it's slowly becoming all three. The Silvus acquisition added a wave of military and international contracts tied to unmanned drones and battlefield communications. Yet, that upside isn't fully reflected in how investors value the stock. At the same time, some areas of the business are slowing, making the strong AI-driven features like real-time translation, automated reporting, and body-worn assistance easy for investors to overlook. Put together, the recent drop looks less like a business problem and more like the market struggling to understand what Motorola is becoming. Financially, Motorola is still performing well. Revenue grew 8% last quarter, with software and services once again leading the way at about 10% growth. That mix shift matters. Software carries higher margins, and it's one of the main reasons the company raised guidance. They now expect stronger full-year sales, better operating margins, and a lower share count. The upcoming Silvus acquisition is also expected to become a meaningful contributor. It brings international defense contracts and exposure to fast-growing areas like unmanned systems and battlefield communications. Silvus is growing 20 to 30% a year, well ahead of the core business, and it positions Motorola to capture more of the drone and defense tech spending boom. The backlog remains extremely strong, with well over a year of revenue already locked in. And despite tariffs and supply chain pressures, margins continue to expand thanks to the software layer. Things like the body-worn AI assistant for officers, automated video redaction, real-time translation, and AI tools that help emergency responders process data instantly in the field. All of this paints a picture of a stable contractor quietly evolving into a more advanced defense and surveillance technology platform. At today's price, Motorola trades at a forward PE in the mid-20s, which is high for a business growing around 8% a year. Using that growth rate plus a forward earnings yield of about 4.2% gives you roughly a 12% annual return potential before factoring in valuation compression. If the stock drifts back toward a more reasonable multiple around 18, the 5-year expected return falls to around 27%. Personally, I think MSI is a solid, stable government contractor with a lot of hidden growth potential, especially in defense tech and AI surveillance. The business is strong, margins are improving, and upcoming acquisitions could accelerate growth. That said, the stock isn't cheap enough to justify big upside today. It's a wait-and-watch situation. The biggest risk for MSI is its heavy reliance on government contracts. Even a temporary shutdown or budget uncertainty can shake investor sentiment. Another challenge is translating emerging AI and unmanned systems into sustainable growth. Adoption and integration takes time, and some products could underperform expectations. The broader takeaway is clear. Not every company with AI or tech buzz will deliver explosive returns. Some, like Motorola, are quietly building recurring revenue, high-margin tools, and strategic positioning in future markets. That slow and steady evolution can be highly valuable. It just needs to be purchased at the right price. Both RELX and Motorola show that not every stock tied to AI or technology hype is going to deliver explosive growth. RELX got priced like an AI rocket ship, but is really a slow and steady compounder with government exposure. Motorola is a stable government contractor quietly evolving into a defense tech and surveillance play. Both have strong fundamentals but are not cheap enough for a massive upside today. The key lesson for investors is to separate hype from reality. Some companies use AI to enhance sticky products and improve margins rather than to turbocharge growth overnight. Watching how the market reassesses these stocks helps you understand which trends are sustainable and which are just short-term excitement. If you found this breakdown helpful, hit like and leave a comment with which stock you'd watch closely next. If you have any questions, join me on Discord. Link in the description. I'd love to help you. Thanks. Bye.